Alright folks, welcome back. Well, we've finally arrived. This is model number 12, Algorithmic Theory and Lecture for the scalping model, and it focuses on 20 pips per trade. This one here is kind of like one of those bread and butter setups. These tend to repeat a lot. There's generally something like this every single trading day. You'll have to look through, obviously, a lot of the pairs and futures markets, but something is running out a previous day's high, okay, or previous day's low, or making an attempt to do that. Okay, so let me make sure you have that in your notes. You may expect the market to rally up to take out a previous day's high, but if it offers 20 pips before it gets to that previous day's high, that fits in this model. So I think if you've been paying attention, this is what I said before we even started the charter membership. Okay, before I even started doing price action models, I warned all of you in the recordings leading up to it that you're going to find that these models overlap. There's a lot of similar things, and your mind should be thinking, this looks similar to this, and this feels like that, and because they're all connected. Over time, how much time I don't know, but each of you, if given enough time, working with them, studying them, your mind will start seeing how all of them plug together. And it gives you like this tapestry, how they all connect. When one's doing something and when it ends, another model starts working. So there's always something that moves and gyrates between the marketplace. That's why some days when it's really nice in terms of volatility, I can go in there and I can buy and sell and move from one thing to the next, like Spider-Man, web slinging. And to a neophyte or someone that's been trading for a while and they see that in my recordings where I'm doing the executions both sides of the marketplace, getting out at the highs, getting short, going down to the lows, covering short and going long, there isn't a market environment that sees that repeat a lot. But when it does manifest itself, you can use this model for intraday web slinging. Okay, it's very fun to practice in a demo doing it, but I don't want you to think and go out there with a live account and start doing it because none of you are right at that level yet. Don't be put off by that comment. Trust me when I tell you, especially in the market volatility we have today, in the last 18 months or 2 years or so, it's very difficult, okay, to find real nice pristine symmetry in the marketplace. It's really short-lived when it happens. You got to get it, secure the money, and go, okay, and try not to be thinking at the end of every trade you just closed there should be an alternative trade. Okay, that's a neophyte. That is someone that is a gambler and someone that feels like they got to be in the market all the time because they're afraid of missing something, or they're addicted to winning. Okay, or addicted to just the action alone. So this model can present a gambler a lot of problems, and you have to be careful that you don't go in here and try to abuse this one because it's there all the time, but you have to be careful what you're doing and try not to be a gambler or an action hound or a junkie, put it that way. So this model, it's built on the daily range expansion, so you're not really relying on anything from the weekly, and all you have to do is try to figure out at the beginning of the day, is it likely to run for previous day's high or previous day's low, or expand in either one of those directions, allowing for 20 pips. Okay, so it's really an intraday model that takes advantage of volatility without bias, really, because you could really flip a quarter and heads buy, tails short. And as long as you know what you're looking for through market structure, intraday volatility, chances are you can probably find a 20 pip runner intraday and really be against the daily range expansions. I'm saying that just to get your gears turning because there's a lot of volatility in the markets today, and sometimes it offers that in a very choppy range-bound market. And if you put too much emphasis on daily range expansion, directional bias, you could miss out on some really nice moves. And I don't want to lay that in your lap and kind of like inspire more fear of missing out. okay? But I'm speaking to the more refined you as the student, not right now, because you just completed all the models, you have all the algorithmic principles, you have the trading plans, you have the logic, and what's going to happen now is you're going to go through them, and you're going to think about which one resonates the most with you. And it may create a hybrid. It might blend one or two, or maybe even three of them with your own unique model. You're not limited to just this. I'm not saying that this is all ICT concepts are limited to. I wanted to give you a pretty broad spectrum of what you can do with the things that you learn here. And obviously I just gave another one on YouTube this year. And you can make it as simple as you want it to be. And today, everybody, without me even talking about what to do, they were out there going short E-mini, S&P, and NASDAQ, catching the fair value gap after buy-side liquidity and running to sell-side liquidity. And they're elated, much like you will be once you settle in on your own unique model. And it might be that one that I gave to YouTube. There's nothing wrong with that. But for this little pattern here, this setup or model, this dandy here repeats a lot. And you can trade this in the morning session, and you can trade this in the afternoon session. You can be one direction in the morning and the opposite direction in the afternoon, or same direction from the morning and same direction in the afternoon, if you know your market. Okay, and there's a lot of volatility in index futures, and I think this one here, if you treat it instead of 20 pips, if you did something like 20 ticks, okay, that would be about 5 points. Okay, or 5 handles in the S&P or NASDAQ. On a mini, one mini, that's $250. There's nothing wrong with that, folks. There's a lot of people that don't even make that in a day, gross, before taxes. So if you're able to get 5 handles, in a session, once a day, trading one mini contract, that's awesome. Like my son literally made equivalent to 2 weeks of his income in his most recent trade on the 31st of May. And his elation was, Dad, this is really incredible. I mean, he's had bigger trades, obviously, you'll see some of his statements, but to sit down and say, okay, I only want to do one contract, try to do, what would be my weekly income, because he gets paid, I think it's called biweekly, where you get a check every 2 weeks or something like that. In other words, he gets 2 checks a month. So he has to work 2 full checks before he gets paid. And he doesn't get paid a whole lot. So equivalent to like $400 a week. And I don't pay for his gas. I don't do any of these things. And he didn't complain at all. But he's sick of his job. So we kind of use this model here and a blend of what I taught on YouTube. So for all of you asking, what is he using to run that account up? He's not using Enigma. He's just learning, folks. I mean, he really doesn't know a whole lot. And I am sitting next to him, and I'm telling him, what do you see here? And what do you see there? Am I pushing the button for him? Absolutely not. Am I trading his account for him? Absolutely not. Is he making poor decisions before he pushes the button? Yes. Am I saying something to prompt him to second guess that poor decision? Yes. Okay, so this model has a lot to do with what he does. This one right here. Because he has a very short attention span. He doesn't have a lot of experience, so he doesn't have that, well, this reminds me of that other trade, or this reminds me of that one time when the market does this or that. He is just looking at old highs, old lows, fair value gaps after short-term little shifts in market structure, and it's easy for him to spot it. So I'm trying to cultivate that. You may not look at this model and see it as something that's viable for you because you want something more heartier, more beefier, something like Model 6 and 7, because you've heard me say that's closest all of these to what I actually trade like. And I want you to think about how often these little short-term moves present themselves. And if you're able to just lower your expectations and also reduce your pressure on yourself about doing bigger trades. Okay, bigger is not necessarily better. If you can find a lot of 10-point moves in an index future, I mean, think about it. One mini, that's $500. 10 handles in one mini contract on the S&P, that's $500. If you did that 3 times, that's $1,500 a week. Do you make that a week at your job? How about if you're able to do that once a day? Say get 5 pips, or not 5 pips, but 5 handles in the morning session and 5 handles in the afternoon session. That's 10 or $500 a day, or $10,000 a month. How many of you make $10,000 a month? So when I'm looking at this model, I'm teaching it with the perspective that don't think it's just 20 pips. It might be 20 ticks in the SPOOS market, in the S&P. That would be the equivalent. So you can scale that 20 pip part of it to whatever you want it to be. Don't be afraid of saying, oh, I'm going to just try to do 10 pips in Forex. There's nothing wrong with that. You can do 5, 10 pip trades a week and make 50 pips a week. It's done. You've met your objective. Who's going to complain about that? I just think it's a lot of work. It depends on what you have in terms of your time, what you have in terms of your, well, what's the schedule like for you? Do you have a whole lot of time to do this? Do you want to be in front of the charts all the time? Do you look at this and not see it as stressful? Because a lot of you are going to discover that being in front of the charts, while it can be profitable, and I can make a whole lot of money if I sit in front of these charts all day long, I can do that. But it wears me out, and it's tiring, because in my mind, I'm racing to get every single price swing how I want it. So what I like to do is go into a specific time of day, and that's why I created the kill zones. So if you limit yourself to any one of these models, try to emphasize time management, because when you start getting good, you will start pushing everyone and everything away, and you'll just be wanting to be in the markets. And all of a sudden, your children will grow up and you don't know who they are. And that happened to me, literally. So if you're comfortable with trading index futures, you can use that 20 as a 20 tick, or 20 handles, or 10 handles. Okay, whatever you want it to be. Or you can use it as pips for Forex. Or it could be 20 ticks in the bond market. Okay, $31.25 each tick. Yeah, that's a good chunk of money. So if you're doing that over multiple contracts as your equity grows, you can turn this into whatever your imagination can come up with. There's no limit. But many of you are going to be in a rush to do this, because you've seen many times me take small accounts, run them up real quick at breakneck speed. And honestly, I wish I could go back in time and undo that. I wish I wouldn't have done it now, because it's made a lot of you feel like that's what's expected of you because you're my student or you've gone through this mentorship. And that is not what I want any of you to think. I don't want you to think that. Okay. Could it be a goal for some of you? Absolutely, sure. You get in there and go crazy, win the Robbins Cup, do something spectacular. I would be the first cheerleader for you. I want to see it. But some of you just don't want that, and you just want to make an income. Guess what? That's this one here. This one right here. It's easy. It's short term. You don't have to hold over day. The whole entire day. You don't have to hold for it. You don't have to hold overnight. No weekend trading. You're in and out just like that. Hit and run trading. Okay, that's kind of like what this is really specializing in. So really looking for the daily range expansion, and that might be just, is the next session in London going to be a session where it expands higher or lower? Or you look at London overnight, what did it do? Does it look like it wants to run continuously in the same direction that London did in New York? And that range expansion inside the daily range, okay, it doesn't need to be the full daily range. You just need the expansion inside that same daily candle. Much like we were discussing throughout the entire mentorship with these price action models, we are looking for an expansion on the weekly range, but we're not trying to pick the closing price. You know what I mean? So it's like we're looking for a flurry of action, like this little moment of excitement where it's going in a direction we are looking for, but the technicals and time and price all come together perfectly. And then we can engage. So I'm going to take you into an example here and try to walk you through something that would have been feasible with this. This is the dollar Swissy, and this is a pair I admittedly can't stand, but I know some of you in here trade it. Here is the daily chart. And looking at the daily chart here, you can see that we have a fair value gap here. We have what will be equivalent to a potential swing low forming in here. And there's been 2 up close candles. And it might want to expand up into that fair value gap. Now, I do not need, and you don't need it to actually get up there. But that's enough to build in a short-term bias going into the next trading day. And if we open below this candle's high, does it give me an opportunity to run that high and get 20 pips? As you can see,